5 to 10,000 return in the week. But was it easy or was it difficult? Actually, in fact, this week was probably the most difficult from the previous weeks that we'd been trading post this Iran situation. As you probably remember, because we've kind of covered this in multiple conversations, we have found the last 5 weeks to be exceedingly profitable for us, even having weeks returning over $20,000 and $25,000, even if you are only taking the systematic trades with one contract, which is quite phenomenal since each contract really never requires more than anywhere between $500 of risk up to $2,500 of risk. So those returns are really great. However, this last week, I can admit that for specifically some of our day trades, this was a more difficult week. Our overnight trades did very, very, very well just because volatility was so high, up above even 500%, that the return on those trades was just so significant. But the trades that we had to take during the day were a little bit more complex. They were trades that we did have to focus on more and manage more, which generally speaking, we try not to engage at all with, because of the fact that the systematic nature of the trades is very much time-based or structure-based. And so we know anytime we're using a very specific structure, exactly what the returns should be, and then what our max loss should be. And that's how we calculate over time that the win rate in relationship to the returns is, and also in relationship to the losses, is going to continue to be green week over week and month over month. But there are weeks like this week where just the dynamics of the price action are a little bit unique, and you do have to engage with a little bit more assertiveness. So I do want to acknowledge that this week we only saw really between a $5,000 and $10,000 return, which is still a great return considering that the market is down so significantly. But of course, it is very frustrating for those who are newer to the trades and are just starting out and trying to get used to them to have to face this kind of volatility. Now, you can look at it from two different directions. This is probably the most difficult type of market to trade with systematic trades because of the fact that it is significantly outlier, and we just have to accept that. One of the things I did mention in my group, and this is something you can look up if you just like to be a data person. So oftentimes we talk about the one standard deviation. We don't often talk about a two standard deviation because it is so rare that price will go outside of the one standard deviation. The one standard deviation is basically 68% of the time, whatever you are looking at. I don't know why I keep doing air quotes. I need to stop that. 68% of the time, whatever data set you're looking at. So grades out of students, how often you will get to school on time, how often you will find X at some certain price point. So usually the average, people will say 50-50, right? But usually the distribution is around that 50% point. So the thing is that in your distribution from 0 to 100, 68% of the time you are going to be inside of that average. And that is your one standard deviation. But 95% of the time, you will be inside of a two standard deviation, above and below. And so the bell curve, if you normally look at it, it's really high at the top and then narrows down to almost nothing. And so it's very rare to see things happen outside the two standard deviation, or as some people like to call it, depending on the measurement they use, the 2 sigma. And so it's very rare to see those extreme tail end events, even when volatility is high, because volatility by itself isn't really the most important data point. It's volatility against the general surface, as some people like to say. You can look that up if you want to have more information about the volatility surface. That's probably more information than we need now because we really just want to talk about charts and how to make money in the markets. But one of the things is that we've had 4 days in a row where we have closed the market below the 2 standard deviation. So the two standard deviation happens 5% of the time. And if you think about it, when you're actually looking at the standard deviation, it's 2.5% of the time on this side and 2.5% of the time this time. So let's say, for instance, you are a student in school, you might 2% of the time get 100% out of 100 points out of 100 points, but just as rarely you'll get 2 points out of 100 points. Getting a 2 from 100 or getting 100 out of 100 is very rare, but the normal distribution is that you're going to get somewhere between the 60s to the 80s or 90s. That's kind of where most of the students are going to fall. But so the market basically was giving us 2 out of 100, if you want to look at it as distributions, 4 days in a row, which statistically is just so unlikely and so rare. And a lot of times people ask me, when you have these outlier events, how do you respond? Well, you can respond with a lot of nervousness. And if you are newer to a systematic trade, it can cause you to do that. But the problem is that what you will end up doing, and we have to be very careful about is you never want what happens 2% of the time to impact what is going to happen 95% of the time. Because more likely what you're going to do is impact your wins and not reduce your losses. You will just make yourself nervous and cause yourself to start engaging with too much discernment inside systematic trades. The other thing, and we'll talk about this because we will talk about some charts, is that you always have to remember, what was the premise of the trade that you developed? Was it a time-based trade? Was it a price action trade? Was it a breakout trade? Was it a oversold, overbought signals trade? Was it an ABCDEFG trade? Was it Wyckoff? Was it whatever? But the problem is you don't want to be entering trades because this is an Elliott wave signal and then exit the trade because of an RSI and then re-enter because of a MACD and then exit because of Wyckoff and then re-enter because of a fib retracement and then like this, you're just confusing yourself. And even if you had to sit down and explain it to another person, you would sound chaotic, because just like I sounded like I have some kind of illogic to my thinking, you're going to bring that lack of logic and structure into your trading. And so that's why a lot of times people will ask me questions. And my first response as ever is this a price action based trade? Is this a time based trade? Is this a wave based trade? And you have to make your decisions consistently based on the same logic. You cannot open and then close based on different kind of theses, or otherwise you will just always be confused and you'll never be able to improve your numbers. Now, it could be that you've done 5, 6, 7 years of testing and you've seen that actually the best entry is given by price action trading on supply and demand, but the best exit is given by a fib retracement. Well, if that is your system, then that's totally fine, but then that will be consistent in everything that you say. And people who are listening to you will understand that from day one. But you don't want to be doing something where each day you're coming to the market and applying all different kinds of information and knowledge on top of each other, because you will never get good at anything because there are too many things you're trying to do at the same time. And the reality is the market isn't the place where you want to be the jack of all trades, master of none, because the reality is that, yes, there are aspects of life where you do have to be a little bit good at a lot of things. Parenting is probably one of them. You have to be a good driver. You have to be a good cook. You have to be a good cleaner. You have to be good at time management. You have to be a patient person, whatever. You have to have about 1,000 skills to be a good parent, or even to be a good employee, or to be a good teammate, or a good spouse, whatever. But in trading, you really do want to master each thing one step at a time. And the more chaotic people are when they start trading, the less likely their success is going to be at the end, even if they spend 2, 3 years trying to do all the things, because in fact, they never truly understood one system or one strategy or one charting pattern well enough to really be able to say, every time I execute thing A or B or C, I do it with excellence. They can't say that. They can say, I can do A, B, C, D, E, F, G, H, I, J, or whatever. And it's like little, and everything comes out like mashed potatoes. Is just watch. Oh, that's German, but whatever. It comes out as nonsense. But you understand what I mean. So let's look at the chart and let's talk about what went on this week. So First of all, these were our systematic trades for the week. And as you could see, we did have some significant down days, but also we had some really strong up days. And not only that, even on the days where we did struggle here, this loss was actually, we already had almost a 40% decay. So we took in $5,500 of credit. We were up almost $3,000 before this turned around to a max loss at the very end of the day. So if anyone was watching this trade, which you should have been, and inside the Discord, we did alert it. We said this is a good time to consider exiting the trade, similar to this one, where on the trade you were up 10%. And usually when we're up 10% on the trade, we do encourage people to put in a stop loss or move their stop loss up to avoid taking a max loss at the end of the day. So no one should be taking max losses, especially when you are already up 10% on a trade, because 10% return on a credit of $2,500 is significant enough of a decay that you do want to be cautious of the trade turning around against you, especially if you understand the premise of the trade. But overall, you can see we had days with really nice returns of 3,300, 2,700, almost 1,000, 1,500, 1,800. And as I said, this here, I show you always the trades. If you were to enter and you just exerted zero management, even if you exerted no management on this week, you still would have ended the week green, which is important for people who are under, their accounts are under PDT rules. But of course, you don't want to see this much volatility in your account. That is not something that we recommend. But some people, they like to enter trades and just leave them until expiration. They don't like to manage. It's everyone's business. I don't manage people's account. I'm not financial advisor, but these are the trades that I'm taking so people can understand. I do give all the opening and closing orders that we see. And let's look at some charts. So this week, again, you can see that looking at the daily chart, we've had a really nice uptrend into really early October after this really strong downtrend based on all of the tariff news and Liberation Day and ABCD. We had this massive move down and then a really strong pop up. And then we gave ourselves 4 really nice zones on the way up. And then we started to mitigate the zone and give ourselves this rounding top. Now, here we are inside the second to last zone. One of the things that we do recommend to people is that once you've had an origin zone, which is actually the origin of the up move, so we can change that to make it clearer, you do want to look for 3 to 4 good zones before you start seeing price give a pullback to mitigate some of the zones below. So here you can see we have 1, 2, 3, 4. This zone has already been mitigated, so it's no longer a strong zone. So when we came back into this zone, we were not expecting price to be able to hold it. Why? Because price had already come through almost the entirety of this zone. So that means that if you're talking about price discovery, that we already came through this 65 to 6,700 level, and we put in new highs, but we didn't do it with a lot of conviction, because as you can see, then we come back and we start really testing the top of that zone. So of course, when you come back into the zone, you already are suspecting that this zone is not going to hold up and that price is going to come all the way through it. But of course, we were not expecting price to come all the way down into the zone. And one of the reasons is because when you do candlestick analysis, we have found that on Fridays tend to have, over the last 12 months, over the last 18 months, over the last 24 months, each 6-month period that you look back, that the Fridays tend to have over 70% bullish days, flat. And when you include flat to bullish days, that percentage increases significantly. So because of that, we usually are not expecting not only to get a heavily bearish day, but to get a flat bottom day. So here you can see that essentially we just sold all the way into into the close, except for the very last few minutes of the trading day. That's quite abnormal. It is less normal when you have a very strong bearish candle or even a strong bullish candle that you see one type of buying or selling all the way into the day, end of the day. Now you have certain days like this where where it does have a flat bottom as well. So you know that the selling was going on into the end of day, but you did have a lot of price discovery where here in the candle you open, you run up, and then you come back down, and then you're slowly pressing in towards the bottom of the day and then selling throughout the day. But you notice that the candle is not so massive, where this candle is quite certainly a very, very aggressive candle, where in one single day you run all the way up to the 6,500 and then move down to almost 200 points. That's quite abnormal, and that is something that you don't want to be basing an entire strategy around those types of candles, especially when you know that on a Friday, that's unlikely to happen. But it's quite clear we had this really strong rounding top. We came back into this zone that we had already mitigated multiple times, and we couldn't really get any new highs coming off of this. We just got lower lows and lower highs all the way down into this aggressive selling on Friday, based on the uncertainty of what is going to happen in the markets. Now, one of the things that people have been arguing, and I have not argued this, I've actually argued the opposite side, is that the markets are obviously have had a rotation. That's correct, that we've rotated more back into commodities and into oil and energy. And then, of course, the situation of the Strait of Hormuz has given us more intensity in the oil markets and in the energy markets. That's absolutely true. But the big thing that people were really promoting the last couple of weeks was buying software, because those had been the hardest hit. People were really trying to push for people to get into those stocks. Now, we did show the chart of three charts that we had been looking at and we had been trading, which was CrowdStrike, Net, and APP. And as you can see from my notes, I did indicate that I did not see that we were going to break above this trend line. I said that you needed to be aware that we were in a downtrend, that it was nice to get a short-term play up into the trend line. But as you can see from Net, did get a little bit above the trend line, but then rejected immediately inside this supply zone, which I highlighted, I think 2 weeks ago. And then APP, which looks very much like CrowdStrike, basically just because of the overextension to the downside, popped back up to the trend line and then reject again. So one of the things that people often talk about is relative strength and relative weakness. And you don't want to talk about relative strength when something is in a downtrend, when it is demonstrating overall weakness, because then what you end up comparing are two weak stocks and you're trying to find which one is the strongest. But actually, when you want to compare relative strength, you have to compare two strong stocks, so two stocks that are in an uptrend, or three stocks or two or three sectors that are in an uptrend, and then you compare the strength to each other to see which one of the two or three has the most buying action. The point is not to find which ones are selling, which sectors are selling the most aggressively, and from that aggression in the sales, which one is the least aggressive. That's not how you compare strength, nor is it how you compare weakness, because really what you are comparing is then which one is the weakest stock, which one is going to most likely continue to go down. But you don't want to be comparing the relative strength of weak stocks. That actually doesn't make sense in the mathematical structure, because that's not what relative strength is trying to compare. Relative strength is from the strongest Olympians, who is going to be first, and then from the non-Olympians, the couch to 500 personalities or the couch to 5K personalities, which one is going to perform the worst. That's how you want to measure it. You don't want to then look at the weakest runners and then try to find which from the weakest will be the strongest, because none of them are actually going to outperform any of the stronger things. So you want to find relative strength from the strongest and relative weakness from the weak. And this is one of the reasons why, because people might have said, oh, net is has the strongest chart of all of them. So that's the one that I'm going to try and participate in for an upside trend. But in fact, it also just rolled over at the same time that the others rolled over. It's just that it had so much consolidation for so much longer, because of the fact that it basically hasn't done anything since last August, that it had a bit more strength after its earnings. But then, of course, it is also rolling over. So this is how we look at price, looking at supply and demand zones, trying to keep the price action as simple as possible. But right now, our main goal isn't about dollar cost averaging, because dollar cost averaging, you don't want to start your dollar cost averaging until you have found a base. This is a very clear signal of distribution. So here would be a nice time to take some profits on your SPX trades. And to be honest, for most of our SPX trades, we actually were taking our profits up here. And in part because we didn't want to have to suffer from time decay on any of our contracts, because whatever our gains were here would not still be our gains over here, even though technically SPX is at the same price of 6,900. But the fact that we've just had a massive amount of time decay wouldn't really have helped any of our diagonals or calendars on the S&P. So we close those up. Now that we have had this really nice pullback into the 6,300 area, we have added some testing calendars, but those are very, very, very inexpensive. They are very low cost to us. So we are dipping our toes a bit, but the expectation is really that we can get out of those profitably if we can see a retracement back into this zone, even if then the S&P does decide to make a massive leg lower. Now, the reality is that we are in negative gamma, which causes a lot of more chaotic price action. So we have to expect that we can get a lot more of this kind of erratic behavior in the S&P. But we did have such a significant push down on the Thursday and Friday that going into this next week, we could very easily see a retracement back up into the range before we see another rejection. That would be a good time for us to determine if we want to take some profits off the table. One of the other things that people often forget is that just because we're trading systematic trades doesn't mean that all of our trades are correlated to each other. All of our systematic trades are based on totally different reasoning. And so because of that, they are really uncorrelated to each other, because most significantly, or their engagement interaction to volatility is very, very, very different. And so this is why in a week like last week, where volatility was extremely high, we were still able to be very profitable, because what we've talked about the last couple of weeks has been really based on volatility, is that we've been doing a lot of double diagonals, and we've built those double diagonals to be able to make the most amount of money on an increasing VIX, because our expectation was that on the VIX, the risk was to the upside. And we have seen that very clearly, that either we were going to continue to have some this chopping sideways action, or that we would overall see a very nice continuation to the upside, which we have seen. And because of that, our double diagonals really benefited from this, from the increase in volatility. And also our overnight trades take advantage of the fact that the overnight volatility was very high because of the fear of unexpected potential events during the overnight. But the volatility was so high at 500 and 600% that even if the S&P would move double or triple its normal movement, most likely wouldn't do that overnight, and most likely wasn't going to make a 600-point drop, which is what the volatility was baking in. So we were able to take advantage of that because of the way we structure our overnight trades, unlike our zero DTE trades, which really are a function of very time-based patterns, which over the last 6 years have had over a 90% situational presentation. So 90% plus of the trading days of the last 6 years, we have continued to see the same exact time-based patterns pop up. And so we want to take advantage of those as much as possible. Now, going into this coming week, we're continuing to be cautious just because of the fact that Trump doesn't have as much power in this conversation about what's going on with Iran as Trump did with tariffs. Really, Trump held a lot of the cards and was able to really end the threats. But the situation now is that Iran does hold a lot of their own individual cards where they exert complete control, namely things like the Strait of Hormuz. And the other aspect is that Iran is now reopening negotiations with each individual country inside the Gulf cooperation countries, which would include countries like the United Arab Emirates, Saudi Arabia, Oman, Bahrain, and Qatar. And as you can see over the last week, because of how Qatar has faced challenges with the destruction of their oil fields, and same with Iraq, that actually this bifurcation and pressure on everybody now having to choose sides has actually driven Qatar to become much closer to Iran as well as Iraq, which is very unique because the GCC countries really did work hand in hand together. Now, Saudi Arabia has become a little bit more vocal about their siding with the United States, as well as the United Arab Emirates. So it does show that now there is a bifurcation between the Gulf cooperation countries, which is quite significant, that they have had a very strong cooperation with each other on and oil and energy supply their area, but the ongoing instability and how decisions were made, Qatar would like to have more autonomy from the United States to be able to exert their independence on energy and energy decisions. So, seeing that Trump doesn't have the control over all moving pieces, and certainly exerts very little control over Iran, but much more importantly over China, as this is really a ideological war between the U.S. and China. To engage against Iran was obviously something that was propagated, has been, focus on to exert their dependence, autonomy in the region, that they really had always found it would be necessary to have a regime in Iran. But and for a lot of people who look back at the time of the Shah as being this renaissance in Iran, for older Iranians, especially those who have remained inside Iran, they do not see the Shah or the previous regime of the Shah as being positive, because the Shah essentially gave up all the natural resources in Iran almost for free to the British. And this created a lot of resentment that a country that should be one of the wealthiest countries in the world could never take care of their own citizens, because of the fact that the British were essentially robbing them of all of their resources for, frankly, nothing. So they tried to exert sovereignty over their own natural resources by a regime change from the Shah to the freely elected Prime Mossadegh. He nationalized all of the natural resources because he felt that the Shah had not negotiated in good faith, and that the natural resources did belong to the Iranian people and did not belong to the Shah himself as an individual, which is how the Shah negotiated the terms of agreement. Now, of course, the British didn't like this because they were losing, of resources. And so in cooperation, many of the Western countries, including the United States, France, and the UK, did engage multiple assassination attempts against Mossadegh. Then they started funding openly gangs inside to kind of overthrow minister, and eventually, because they were not able to assassinate Mossadegh, they were able to get gangs to overthrow him. Then this is where we started to see the rise of Khamenei and Khomeini and intensities across the region. But it really does come back to natural resources, control, and funding, what corporations are allowed to do and not allowed to do when corporations negotiate in bad faith and negotiate terms in a way that is very destructive to the population. How do countries that want to exert independence post-imperialism, how do they do that safely without those imperialistic countries coming back and undermining their sovereignty and autonomy? And, so people inside Iran haven't forgotten that. Americans have forgotten that because they didn't live through the poverty that had been created by the Shah, even though they see that time as being a very liberal and open time for the Iranian people who were not part of the remember how difficult Iran was because of the amount of resources that were just being stolen outright by British companies. Oftentimes that people have lived decades and they remember the devastation that they lived through. For the people living in Iran, no matter how you want to slice it, don't want to go back into an imperialist mindset. They do want to be recolonized, essentially, by the British, nor by the United States or the French or whatever gaggle of imperialist countries want to gang together to do this kind of recolonization of the Persian Empire. That's the people in Iran are sitting back and allowing to happen. And the United States just underestimated that, the resilience of the people and the long memory to have suffered under colonialism and imperialism. So, Trump played that hand, hasn't played out as he expected. So we do see that there is a potential for a protracted, dynamic where get to negotiations quickly. We will continue to see VIX go up just because of the nature of the fact that energy prices are going to go up. And as energy prices go up, that has a significant impact in areas like consumer staples, retail prices, just overall supply chain. And one of the factors now is what is going on with fertilizer. Because one of the things that we often do not talk about is how much the phosphorus, natural resources that are part of fertilizer, which is a part of agriculture, even in the United States, actually comes out of the Gulf countries and requires the Strait of Hormuz to be able to move those prices. So if you've been watching anything from the news in Australia and India, you'll see prices are already going up very, very quickly. They have energy on usage. A lot of grocery stores longer have access to a lot of agricultural goods, so basic fruits, vegetables, that they're no longer having those imported into Australia in certain areas. So you can see that the price of something like mood, the agribusiness, it has remained extremely high. Since back in April, we saw this down at almost $60, and now it is up at 82 and continues to hold. But this could very well go up to either 90 or 97 if we continue to see the Strait of Hormuz continue to remain closed, because that means that fertilizer or the chemicals required by fertilizer required for fertilizer will not transport it out of the Gulf region and to major agricultural providers. Now, in part, we know that this can have such a significant impact is because of the fact that, and here you can see during 2020, when supply chain was significantly inhibited, that moved from $40 all the way up to $110 because supply chain and supply demand were completely off. And it took a very long time to get those back on center. And then as the supply chain corrected, we saw this retrace, but it never retraced back to the lows. And now we're continuing to see a price movement up. In the Russia-Ukraine situation, it was a very big fear because of the fact that a lot of chemicals for fertilizer came out of Ukraine and Russia, and a lot of people were afraid that those prices would go up significantly, but the stopgap was to be able to utilize or access those same chemicals from the GCC region. Now you have the combined impact of the fact that fertilizer chemicals from the Ukraine are still not accessible and easy to move around because of the war, nor are they same quality grade. And now you see the change in the Strait of Hormuz, allowing for those fertilizer chemicals to be able to transport out. So we should continue to see increased volatility because there are so many unknowns, and those unknowns continue to become less, not more clear. And usually with volatility, the expectation is once an event has started to take place, that on the backside, that there's a bit of clarity. But with this situation in Iran, being that Iran did retaliate against many of its neighbors because of their kind of silent siding with Israel, this created a new element for many. And as I said last week, for every week that the Strait of Hormuz is totally closed, we should see an increase in crude by about $15. And you can see here on last Sunday, the price had come all the way down to 92, and now we are back up to 108. So we continue to assume that, and the reason that you come with this rate that Brent should go up by $2 to $3 a day is because of the impact of supply and demand. That's why that rate is kind of known. So this is why that we continue to see the Strait of Hormuz congested. We will see these prices go up. The other thing, when you are comparing, when you are looking at oil prices, you don't only want to look at Brent crude. And the reason is because each country has their volatility on oil, on natural resources, whether that's natural gas or oil or whatever. And right now we have volatility in some countries like the Emirates or like Oman have shot up to 200-300% against the norm. So whereas Brent crude has actually been quite stayed in comparison to the whole. A lot of the volatility in the pricing, if you are a mean reversion trader, then you do want to look at trading things like Oman oil or Emirates oil, those kinds of industries, because of the fact that they just have a much higher rate of volatility at the moment because the situation is impacting them directly. I don't think the mean reversion is going to happen now because of the fact that one of the things we don't know is the long-term impact of the damage that has been sustained and the long-term ramifications of the potential ongoing damage that be incurred. So long as the situation is still alive and active, then the volatility will remain very high. But when we do come to a point of kind of positive negotiations, the volatility quickly, since that volatility is way outside the range for the individual GCC countries. All right, friends, I hope that was helpful and that this gave you kind of a view like trade, the S&P, how we like to with volatility, how we like to with volatility. But as I've been saying for the couple weeks, the last 5 weeks, most of our trades, 95% of our trades have just been based on the systematic trading style, the style that we utilize, and systematic trades. We have not yet started to buy back into the market, except a few areas that we had already been buying into a long time ago, things relating to electricity, relating to energy, relating to agriculture, relating to, so, areas we had already been for more than a year, even 2 years, those have all been performing very, very well. But of course, start leaning long trades. We are not yet at a point where we think that that is a very good idea to start getting aggressively long right now. Though, in fact, some people have argued that right now the risk is the upside because of the fact that we've had such a fast move down. Again, like I said on this chart, as you can see here, yes, we could get a move back into the range, maybe up to the 6,600. But then if there isn't any resolution on what will happen with Iran, and we don't get clarified news about how this will impact inflation across Europe and the United States, then really the most likely thing is we take a next leg down, and the next zone below us is all the way down at the 5,900. Now, I don't think that we'll do this in one straight shot. That wouldn't make any sense. Even as you see here, the move down from 7,000 to 6,400 was done in, pops and drops. Because of the lines, you don't see it so well. But if you look at this from a line chart, then you can see that much more clearly. This, let's see if I can get it with the candles in the background. Okay. It doesn't want to just give me the lines. I'm sure there's a way to do it, but anyhow, you can see what I mean. You pop up and then drop down, pop up. You're this line down. It is going to take a bit ongoing volatility to continue the pressure. So we do expect that, we can always pull back into and then make another leg lower and then potentially move back into this 5,900, 5,800 range if we just press down low. So I hope that kind of gives an idea again about how we like to trade time-based patterns and not just trade directional trades. It is something that is new for a lot of people that come into the Discord. They don't always understand it, but to be perfectly honest, puts right now are about 3 to 5 times cost because of how high volatility is. Brokers are charging a lot for people to put on their hedges. So it does provide a lot of risk that those puts will not perform. You do not catch a really strong top to a really strong bottom. And it's one of the reasons that we don't just trade naked trades, but we have been able to get 500 to 800% return on our double diagonals because those do have an increased performance when volatility is going up. Unlike long calls and puts, depending on where you position the purchase, out the money, at the money, in the money, the change in volatility against the price can actually cause you to not make very much money, even when you catch a very nice drop down. So, this is one of the reasons there are people who they do is trade long calls and long puts, which is totally fine. That's their trading methodology. But our systematic trading is really based on time-based patterns. So this is irrelevant to just picking directional trades. We're actually focused on I hope you guys have a great week. If you would like to know more about any of our trading styles, then you should consider checking us out in the Discord. If you have any questions, dump them in the comments and we'd love to get back to you. Let us know what you find the most interesting so that, we can be responding to your interest in your request. But if you like this video, like and subscribe and let us get to know you guys. All right, I will sign off. Bye for now, friends.